Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Hello friends, this is Dr. Neelam Panchal from Gujarat University and I welcome you all in the world of finance. Friends, can you imagine life without money? Can you think of any business activity which is working without money? The answer is no. Yes, the fundamentals of financial management occupies a very important for any business enterprise. You may run the business, you may go for marketing, you may go for operations, you may go for financing, but without proper finance management, you cannot go ahead for running the business. So today, we are going to understand the nature, scope and objective of financial management. Friends, can you think of human life without blood in body? Can you think of life without money? Can you think of business without finance? For running day-to-day operations of a firm, it requires skillful planning and control and execution of firm's activities. There is an inseparable relationship between finance, production, marketing and other functions of management. All business activities are dependent upon each other directly or indirectly and involve conceptual and analytical insights to make those decisions skillfully. Finance lies at the root of economic activity. Finance is the lifeline of any business. However, finances, like most other resources, are always limited. On the other hand, wants are always unlimited. Therefore, it is important for a business to manage its finances efficiently. Finance decisions plays a very significant role in the management of operations as money required to support its various activities. This session would focus upon nature, scope, objectives and functions as well as organization of finance function in an organization. Let me explain you the objectives of the session. The objectives of the sessions are to explain you about the meaning and nature of finance function, to make you understand scope of financial management, to explain the organization of finance function, to make you analyze the goals of financial management, and to explain agency problem in financial management. Let's understand exactly what finance means. Financial management means planning, organizing, directing and controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying general management principles to the financial resources of the enterprise. Let's understand what exactly is the nature of finance management. Friends, finance is a part of overall management. Even if you manage everything, but if you don't manage finance well, then it can be a problem to your business. Secondly, finance function is closely related with other disciplines like HR, marketing, operations, supply chain. Everywhere you need funds. Everywhere without fund you cannot start, you cannot run successfully a business. Thirdly, financial management is a continuous process. It's not like once you have borrowed the finance and you have allocated the money and the matter is over. It is a continuous process whereby at each stage you require finance. Fourthly, financial management is different from accounting. In fact, accounting is a branch whereby you are trying to keep records of the transaction. But in finance, you are trying to know about how to procure the money, you're trying to identify the sources of finance, you're trying to allocate the money as per the requirement of the business, and you manage the show. So, the point is, finance is totally different from accounting because it is more of management than recording, which is in case of accounting. Fifth, finance is a helpful in decision making. Friends, in any decision making, finance is very important. If you don't have proper allocation, then you cannot do proper management. It has a wider scope and a very wider level. Finance is both science and art. Science because it is a systematic process. Science because it requires a research, it requires a proper allocation, and it is an art because it requires skill set to perform the functions. Now let us understand what is the scope of finance function. Friends, basically finance involves three important decisions. First is investment decisions. Investment decisions include investment in a fixed assets, which is called capital budgeting, and investment in a current assets, which is called working capital management decisions. So basically, when a firm starts, it has to invest either in the fixed assets or in the current assets, but in what proportion to invest and how much to invest, that is a very fundamental and important task. So the first important decision is an investment decision. Second is a financial decisions. Friends, financial decisions that are related to raising of the finance from various resources, which will depend upon the decision on the type of source, period of financing, cost of financing, and the returns thereby. So, in financing decision, what you are trying to do is you are trying to identify the sources of finance, and then you are trying to look into the cost of capital for each source of finance. You are trying to compare which is a better and a feasible option for you, and then you are trying to structure your capital for raising the finance. So basically it can be divided into two parts. One is raising the finance and the second is a capital structure decision. The third decision is a dividend decision. The finance manager has to take a decision with regards to net profit distribution. Net profits are generally divided into dividend for shareholders, that is dividend, and the rate of it has to be decided. The firm has to decide how much to pay. And secondly, retained profits, that is amount of retained profit to be finalized, which will depend upon the expansion and diversification plan of an enterprise. So basically, dividend decision would focus upon how much to distribute and how much to retain. Thereby, the retention distribution ratio would be decided by finance manager while taking dividend decisions. So, in general, if we say what is the scope of finance management, we can say that finance management is included three important decisions: investment decision, financing decision, and dividend policy decision. Friends, now let us understand objectives of financial management. The financial management is generally concerned with procurement, allocation, and control of financial resources of a concern. The objectives can be: first is to ensure regular and adequate supply of funds to the concern. Secondly, to ensure adequate returns to the shareholders, which will depend upon the earning capacity, market price of the share, expectations of the shareholders. Thirdly, to ensure optimum funds utilization. Once the funds are procured, they should be utilized in maximum possible way at least cost. Fourth, to ensure safety on investment. That is, funds should be invested in safe ventures so that adequate rate of return can be achieved. Fifth is to plan a sound capital structure. There should be sound and fair composition of capital so that a balance is maintained between debt and equity capital. Now, let's understand organization of finance function. Friends, The financial decisions of a firm are vital important for the efficiency of an organization. The authority and responsibility of finance function lies with the top management. The organization structure of finance function can be seen here. The structure here is representing the overall functions of finance manager. The exact organization structure of the finance department in fact vary with firm to firm. Also, the designation of finance manager will also vary accordingly. The two officers under finance managers in this chart are controller and treasurer. The other officers are as per functional requirements of the organization. The main function of Chief Finance Manager is financial planning and control. He also has to formulate policies and making decisions of the firm. Thus, Chief Finance Manager is the person responsible in the organization and he is a main person behind the organization. Treasurer, on the other hand, is the one who manages the firm's funds. He has to forecast financial needs, administer the flow of cash, manage credit, float securities, maintain relations with financial institutions and protect funds and securities. Controller, on the other hand, relate the management and control of assets. His duties include providing information to formulate accounting and costing policies, preparation of financial reports, direction of internal auditing, inventory control, budgeting, taxation, and so on. The organization, as per its requirements, recruit more number of people in finance departments to have a smooth running of operations. So, in general, there is not a proper formed finance structure. In fact, depending upon the nature, depending upon the scope, depending upon the scale of the organization, the structure of the finance management changes, and that is how it varies from organization to organization. Now, let's understand goals of financial management. The goals or objectives of the firm determine what the firm tries to accomplish and it guides to the decision rules of the firm. Generally, goals can be in terms of maximizing or minimizing selected variables. The very important thing is any goal determined by the firms must be clear and unambiguous. It should be able to evaluate the success or failure of a decision and should be consistent with the long-term existence of the firm. Generally, the two main goals considered by firms are maximization of profit and maximization of shareholders' wealth. Friends, let us understand profit maximization goal. Profit maximization is naturally considered as an implied objective of any organization. If you ask to any manager, what is your goal? They'll say, maximize the profit. Various type of decisions are taken with a view to maximize the profit of the firm. The profit is regarded as a yardstick for economic efficiency of any firm. The profit maximization of own firm is targeted by all firms in general, and so it leads to increase in efficiency and more productivity in an organization as well as welfare of the society in general. It also leads to better allocation of resources so that the targets are achieved. So, not only from the viewpoint of the firm but also for the society, it is beneficial. Though the firm's overall goal is to increase the wealth of the shareholders, profit maximization as an objective overlooks interest of other parties like shareholders, suppliers, buyers, lenders, creditors, and so on. In fact, there are various limitations or objections to the profit maximization as a goal of the financial management. First limitation is it ignores risk. Friends, Generally, the firm attempt so high to increase the profit or earning, but with that, the amount of risk to achieve the profit is ignored. Management may undertake all profitable investment opportunities regardless of the associated risk, whereas investment may not be worth the risk despite its potential profitability. Secondly, profit maximization as a goal is vague and ambiguous. In fact, it does not give a clarity of which type of profit, whether the firm is talking about long term or short term profit. They are talking of profit after tax or before tax. Are they talking for the profit from the point of view of the total funds employed or from the point of view of shareholders only? So, in general, if the firm is saying that we have to maximize the profit, many times people working in the organization are confused. Which type of profit are they talking? Are they talking about gross profit? Are they talking about net profit? What profit? So, in general, it is not giving a clarity when firm keeps goal as a profit maximization. Thirdly, it ignores very important fundamental, that is time value of money. All the monetary benefits and the cost associated are considered in absolute terms with no consideration to values over different time periods. So, in general, what happens is the value of money today is not exactly the value of money tomorrow. Whatever you are buying today with say 100 rupees, the same thing you are not able to going to buy in future. So, it is very important to consider the time value of money, which is ignored by the concept profit maximization. Fourth is concentrate on immediate effect. Profit maximization tends to concentrate on immediate effect of financial decision as reflected in increase in the profit of that year or in near future. It is not necessary will be correct as many decisions have their benefits and costs scattered over many years. Fifth, it ignores financing aspect and a risk of financing. Friends, many times to achieve profit, firm may go for financing from other sources which may have very high cost associated beyond borrowing capacity of the firm. The profit maximization thus concentrates on the profitability only and ignores even financing aspect. Sixth, interest of shareholders are ignored. In fact, profit maximization is not only related to any measure of shareholders' benefits. It seems to be self-centered at the cost of losing attention from the interest of the shareholders, which would be very, very crucial for any firm. So, another alternative to profit maximization is maximizing return on investment, which is also more or less the same. The firm in this case would select those alternatives which will have percentage return in excess of percentage cost of funds. Here also, financial decision makers will be directed in the same manner as in case of profit maximization. Thus, profit maximization fails to be an operationally feasible goal of financial management. Actually, the goal of the firm should be precise, clearly defined and must increase value of the firm, and one such goal is wealth maximization. Let's understand what is wealth maximization. Friends, maximizing shareholders' wealth is the key objective of financial management. The objective is generally expressed in terms of maximization of the value of a share of a firm. The measurement of wealth is a concept of economic value. The economic value is defined as a present value of future cash flows generated by a decision discounted at appropriate rate of discount, which reflects the degree of associated risk. This measure of economic value is based on cash flows rather than profit. Shareholders' wealth maximization means maximizing the net present value, that is NPV, or wealth of a course of action is a difference between the present value of benefits and present value of cost. So, NPV here, that is net present value, is equal to cash flows, that is CT, divided by 1 plus k raised to t, that is 1 plus appropriate discount rate, minus C0, that is the initial investments. Friends, the positive NPV creates wealth for shareholders and so it is desirable. On the other hand, negative NPV destroys the shareholders' wealth and so it is rejected. There are some benefits associated with this concept of wealth maximization, which includes the concept considers timing of cash flows and the level of risk through the discounting process. It implies long-term perspectives of the goal of organization. Also, it is practical and pre-operative. The shareholders' wealth is represented by the present value of all the future cash flows in the form of dividends or other benefits expected from the firm. It represents the market price of share, which is present value of all future dividends and benefits expected from the firm. If there is an increase in the market price of firm shares, it will increase shareholders' wealth. However, there are certain problems with the implementation of the goal of maximization of shareholders' wealth. First, the assumption underlying this goal is of efficient capital market, wherein effect of decision is truly reflected in the market of share. In practice, the share price in the market is subject to influence of so many extraneous factors. Secondly, the objective is uncontroversial theoretically, but in practice, all stakeholders of the firm have different interests which may result in conflict among them. Thus, here we have seen that there are two main goals. One is profit maximization, second is a wealth maximization. In general, wealth maximization is very important objective because it is focusing upon the shareholders' wealth. Now, when shareholders' wealth will come? See, if you have profit, if you have paid all taxes, if you have paid all the financial expenses, after paying dividend, after paying all the financial expenses, you have earning per share. And from earning per share, you would try to distribute the dividend. So, basically, shareholders' maximization of wealth is talking more broader way and thus it is highly recommended goal of the financial management. Now, let's talk on factors influencing financial decision. It includes internal factors, external factors. So, internal and external factors are very important which is impacting the financial management decision. The nature and size of business is also one of the very important. As much as the scale of the operation, the requirement of the finance will be accordingly. Another point is expected return, cost and risk. Whatever is your expectations about the return, whatever is your estimated cost and the risk calculations, based upon that you would have to plan for finance. In addition, composition of assets is also very important. Structure of ownership is also very important, whether it is a sole proprietorship, whether it is a partnership, whether it is a joint stock company. Depending upon the ownership structure, the requirement of the financing change. In addition, trends of earnings is again very important. Age of the firm, whether the firm is newly established, whether the firm is in the growth, maturity, decline, which stage of the life cycle the firm is. If the firm is at the front or the startup stage, the requirement of finance is huge. But if it is in a running condition, the requirement of finance may be stable. So age of the firm is again very important factor that determine the finance. The liquidity position of the firm is also one of the very important concept that is to be considered while making a finance decision. Working capital requirements, that is day-to-day requirement of the capital, is also very important. That will be in fact a determining position. That would be in fact a very important factor which would determine exactly to what extent the company should invest in a fixed assets and the current assets. In addition, conditions of the debt agreements, state of economy is also very important. In fact, structure of capital and money markets are also one of the important considerations while taking financial decision. The requirement of the investors is also very important. The government policy is again important point. The taxation policy, the leading policy of financial institutions are some of the important factors which influence the financing decision of the firm. It will influence your investment decision, your financing decision, your dividend policy decision, and the overall financial management of the firm. Friends, now let us understand agency problem. Friends, generally in large companies, management and owners are far from each other. The decision-making authority in the company lies in the hands of managers rather than owners themselves. Many times we know that shop floor employees are knowing more than the operation managers. Actually, shareholders are the owners of the company and managers are acting as agents. Managers thus need to think and act in the interest of shareholders of the company. The conflict between the interest of shareholders and managers are referred to as agency problem, and it results in agency cost. So, agency cost here includes less than optimum share value for shareholders and costs incurred by them to monitor the actions of managers and control in their behavior. So, when we are talking about agency problem, it's very clear that if I am an owner of the enterprise, my interest is to maximize the profit, maximize the wealth. But on the other hand, if somebody like you is working as a manager, your focus is on salary. How long you would like to work. Say for example, you are a loyal employee of the organization. It may happen that you work day and nights for the organization, but the question is how long. So, the difference between the perspective of the owners and the perspective of the managers working in the organization many times is not equal, and so there is a conflict of interest, and that leads to agency problem whereby the agency costs are associated. So, now let me conclude the session. Friends, we have tried to understand the nature, scope, objectives, goals of finance function. We have also seen the organization structure of finance function. In fact, we have understood by now that financial decisions plays a significant role in the management of operations as money required to support its various activities. The financial decisions of a firm are vital important for the efficiency of an organization. The main function of a chief finance manager is financial planning and control. If the planning is not proper, if he has not formulated policies in a proper way and making the decisions in the firm, there are high chances that the firm may go in failure. Thus, chief finance manager is the main person behind the organization. The goals and objectives of the firm determine what firm tries to accomplish, and it guides to the decision rules of the firm. Thus, Generally, we have seen that the two important goals that are considered by the firm, that is maximization of profit and maximization of the shareholders' wealth, whereby maximization of the profit is naturally considered as implied objective of any organization. Various type of decisions are taken with a view to maximize the profit of the firm. But maximizing shareholders' wealth is the key objective of financial management because it is talking about maximizing the end user's profit, that is maximizing the profit of the shareholders of the firm who are the owners of the enterprise. Without proper management of finance, the organization can never succeed, and thus it is a very important function for any enterprise. I hope you are clear with the fundamentals of financial management and the nature, scope, objectives, goals, the organization function as a whole, and the agency problem of the financial management. I hope you like the session. Thank you.